we really are thrilled to have this panel together, but we're also very aware. We're getting releases signed up here in case you're interested. The no Chatham House rules. This is for posterity's sake. We're really thrilled to have this group of folks here, but we're also, at least I'm keenly aware that we are racing the clock as well. So I want to get started right away. I'll just briefly introduce the panelists to my left. Directly to my left is Chris Hanssens. He's a managing partner at Eureka Growth Capital. Next to him is Chris Miller, who's a partner at Pepper Hamilton. In the middle is Holly Flanagan, who is a managing director at Gabriel Investments. Next to her, David Luck, a principal at Safeguard. And finally, at the end, Jeff Bodle from Morgan Lewis and Bockius, LLP. And I guess we're here to talk really about, I guess maybe giving folks an introduction to what you're all facing in financing of startups and entrepreneurs from the angel stage through the private equity stage. And kind of look, we have a collection of folks who are operating at all different points along that timeline and some throughout the timeline. So I guess I want to start at the beginning, and maybe, Holly, you're the best person to kind of kick us off. You can tell me if I'm wrong. But at the, at that early stage, when you're thinking about making an investment, what sorts of things are you looking for? Are there specific things that are generalizable across prospects that come through, or is it really idiosyncratic that it's difficult to generalize?
Great question. So thanks for being here, and thanks for having us. Just a little bit of context in terms of the firm that I'm with. We're a small venture capital firm in Center City, Philadelphia. We tend to invest in companies when they've launched, they have some kind of early traction. They're usually looking for investment after they've gotten friends and family. They might have gotten some angel investments. They're looking for around somewhere between their seed and Series A fundraising. So maybe $500,000. Anywhere from $500,000 to maybe $4 million is usually the round that they're looking for. And we usually invest around $500,000 as a first investment. So what we're usually looking for is a couple things. One is we're looking for something unique, something that's a little bit different in terms of the product, the service, the team, the market. We're looking for some early traction. Our group happens to be operators by heart, so we look at things probably a little bit different than from some of our counterparts that are looking at early stage. But we're looking for how will you market or sell this product or service that's a little bit different than all the generic channels that exist in the market today. We're looking at team. These are mostly, I think most of us are probably looking at the same things, just at different milestones. So we're looking at early traction, those first early data points, some metrics around cost to acquire and lifetime value, and we're really looking at competition. Again, what the company does a little bit differently than what we're already seeing out there. We're seeing lots of things, in very different sectors. So again, how do you differentiate yourself either through one of those different things?
Jeff or Chris Miller, that is there something at this stage, the stage Holly's describing, is there something either you have seen or you could imagine that is useful for the entrepreneur to know when they're talking to Holly or to Gabriel or to people like that? What are they looking at? What mistakes are they making commonly, if they're making mistakes? Or is it really just you're grabbing the first dollar that comes, and beyond that, you're just hoping to survive for the next year? What's your advice, or what's your thought about the entrepreneur side of this?
Well, I think one of the most important things that an entrepreneur has to figure out is, before they ever have that conversation with the investor, is that an investor the right fit for that entrepreneur and that venture at that time? Because that really sets the dialogue that you might have with Holly, because you may be pitching to Holly, you may be meeting Holly at an event like this, or someone else may be introducing you to Holly, and how you approach your conversation with her may change depending upon where you're at in your life cycle and if you feel like you're ready for her investment. I think there's never an early enough opportunity to build a relationship with someone, and events like this and all different ways that we all get to meet, network with each other are great ways to build relationships and to figure out what types of things Holly wants to invest in. But it's a mistake to just start the hard pitch on Holly right when you see her of how great the business is and she needs to write the check right now. I think that would be a kind of a negative thing that most investors would like to feel. And if you don't know what stage that somebody invests at, I think it's just a classic error that entrepreneurs make. And you may not be ready for funding, in which case you probably shouldn't be pitching anybody. So you have to really dig deep into what's going on into your own venture and what are you ready to do or not do in terms of fundraising.
Yeah, I would just add to that, I agree 100% with what Jeff said. The other thing that you got to make sure of as an entrepreneur in an early stage company is that you really have your act together in a couple of key areas before you ever talk to an investor. And that's primarily around who owns your company, who you've either issued equity to or promised equity to, and also that you own your intellectual property, that if you've gone out and hired third parties to create any kind of intellectual property, whether it's software code or whatever it is, that you actually own it. Because the worst thing that you can do is approach an investor and have them start digging into your company a little bit and all of a sudden find holes. And so it's really important that those kinds of issues, other issues like if you have employees, making sure they're buttoned up with non-compete agreements, making sure everybody that's working with the company has assigned all their intellectual property to the company. Those are the issues that can be deal killers from the outset, because if an investor starts to dig in and sees issues and you lose credibility up front, it's really hard to get it back.
So Holly or David or Chris, to Chris's point, are there specific red flags that you're looking for as you come across these opportunities? I mean, obviously things like team, creativity, the idea, what kind of where the company sits in a marketplace that's either developed or undeveloped. But are there things that for lawyers in the room, for instance, that that you're on the lookout for that just set you back or get you excited one way or another?
Well, so let me answer what I was going to answer first, and then I'll think about like the specific question about like what a lawyer might,
You stumped me on that.
I'm going to have to try to, I'm going to have to take on the perspective. Let me put on my legal hat, for that one. I've never done that before. Never had a reason to, really. But anyway, no. So one thing that I think is really important from where I sit is, like I'm happy to have conversations with people like at networking events and always like, I'm out trying to network with people because like a big part of my job is to go out and source for deals. Like that's a thing that I have to do. But I think that one thing that really is a turnoff is, someone jumping right into the pitch. Like I'm happy to, talk about what it is that we look for, right? Because as an investor, right, I wish I was investing my own money, right? Like that'd be great. And then I could invest in, the next 10x deal, even if it happens to be in, candy jewelry, right? Like jewelry made out of candy, great idea, sure. But that's not what my stakeholders want me to invest in, right? Like that's not why, that's not why I was hired. I was hired to look at, 3 major verticals: digital media, healthcare, IT, and fintech, right? And we invest in a certain stage. And I'm happy to talk to you about it. I don't need someone to go out and Google exactly who I am, what my firm does, and what I'm looking for before we have a conversation. But the appropriate conversation is to at least figure out, if you don't know what we're looking for, we'll figure out what it is that we're looking for. If it's a fit, then happy to talk specifically about your business. If it's not a fit, well, that's okay too, right? Like we all go out and we network, and I'm happy to, come up with some other names for people who are investors in, jewelry, candy.
It is a thing.
Yeah, exactly. I know. I have 2 daughters. So. So in terms of from a legal perspective, I think the only thing that I can think of that's, well, not the only thing, but one thing that I can think of is that legal advisors are often the startup's kind of first official professional advisor, right? And so startups will often lean on their lawyers to make introductions to investors. And so I think as a lawyer that's really focused on the startup space, it makes a lot of sense to build strong relationships with the investor community, and also just have at your fingertips exactly like what Safeguard looks for, what Gabriel looks for, what Eureka looks for.
I want to get back to the sort of the timeline in a second, but since David brought it up, and I think Marla in the original panel brought it up, I'm not sure that people appreciate outside of the world how intensely relationship-driven this is, or at least appears to be often. And I guess the question for somebody who is an entrepreneur that doesn't have those relationships, what do you do? I mean, how do we get in? Is it just having the guts to come to an event like this, or and find Holly or David or Chris and just say, hey, obviously you don't want them coming up if they're unprepared, but I think that that relationship aspect of it makes it maybe problematic for a fair number of people. Is there a solution to that? Is there an answer for that?
I mean, I would say in 2017, everyone is accessible in different ways. So I do think part of being an entrepreneur is taking risk, and whether that's coming up to someone at an event or reaching out through someone you know. I mean, we are all, there's no doubt in my mind that we're all at least second connected on LinkedIn already in this room. But I often think that it's a little bit like selling your product. So I'm more willing, whether I'm willing to answer your email or call regarding your product or your business, if Chris calls me and tells me about you, then you make it a little bit higher in my inbox. I certainly look at everything that's even a cold email, but I might only look at it once a month. But if Chris calls me and says, I'm working with this young company, they're really doing great work, would you mind having a conversation with them? I'm always going to say yes. So I think a bit of it is having, taking an additional risk in how you meet investors, understanding where they invest, because I do think all too often entrepreneurs spend too much time pitching to investors that are not a fit. So whether it's sector, stage, quite honestly, it's just interest or knowledge of the sector. So I think it's understanding who would be a good investor and then being really creative and resourceful, because you also, the other thing to know is, not to say you only have one shot, but when you see David and you pitch him as your company and you're not quite prepared, he sort of remembers that. So it's timing, it's stage, and it's having a good sense for how do you get to that person in the best way. The strongest connection you have is going to be the best into that organization.
So if we progress down, and you've gotten funding from Holly, David, I think you're probably the next step on the road. Maybe is that fair to say? What at that point, what has changed? Do you think between the firm that meets with Gabriel and the firm that's meeting with you? What are you looking for that's different?
So I think the biggest thing is that most likely the company's product is in market, and you have a professional, if not a whole team, but a few professional salespeople on board. And what we're really looking for is a platform that really just needs additional capital to scale, right? So we see the pieces on the every position on the field is now either filled, or you have the right leader in that position to scale behind that leader. And you're able to actually, I think one way of looking at it, in a kind of the simplest way is that like the machine is built that, we know that if we take this machine and we feed it, quarters and dimes and nickels, dollars will come out the other side. And that's what we're looking for.
And Chris or Jeff, what has changed in terms of your advice to the entrepreneurs at this point? I mean, is it the same sorts of considerations that you're normally going through, or has the world of the considerations changed drastically for folks that are now funding at this intermediate level?
Now, one of the things that changes as a company grows and matures is also the complexity of its capital structure will change. And so as an entrepreneur, one of the things that you want to do is take the time to sit with your professional advisors and really understand the world of capital structure and all of the different alternatives, because one of the things that entrepreneurs really focus on, and I'm sure you guys have found this, David and Holly especially, is that they focus so much on valuation and what the valuation is going to be of their company. And one of the things that we know as lawyers, and that a smart, educated entrepreneur learns very soon, is that valuation is really just a starting point in the conversation, and that the terms of any financing are really going to dictate the ultimate economics. And so taking the time to get educated on how venture capital works and the terminology and the various terms is really worth it, because if you go into this without your eyes wide open, then you can make a lot of mistakes, and it can be very frustrating. And also, I think a plug for Jeff and for me is also working with advisors who really know the space. One of the things that can really kill a deal is when a company has unsophisticated counsel that's not regularly working in the space, and it can really slow things down. And that's really on both sides. You know, the investors are going to have good quality counsel. If the company doesn't, it's not good for anybody. It's not like the investors benefit from taking advantage of unsophisticated companies with unsophisticated counsel. It doesn't work like that. It doesn't work like that at the early stages, and Chris, I'm sure, would agree with me that it doesn't work at the stage when you're trying to buy a company. You'd rather have two sophisticated parties talking the language that they both understand, instead of having to spend a lot of time educating and dispelling uneducated misconceptions.
No, I would agree with that completely. I would say the other thing that companies at that stage, that particular kind of post-seed Series A, are thinking about, are you have this extra constituency, have different investors with different priorities who may have different goals in mind in terms of how the ultimate exit of the business happens. So you have to put in a good governance framework to deal with that. And it's important to set expectations among everybody at the time of that investment, how decisions are going to be made on a go-forward basis. And the other thing that may be happening is the new investor who's coming in, and the founder himself or herself may be wondering, am I the right person to take this on a go-forward basis to where it needs to be to get to the next level? So there are going to be conversations as to whether the current team is adequate, or if you need to bring in a new CEO or a new CTO or somehow augment the team. So those can sometimes be difficult scenarios to navigate.
I wanted to make one mention. I wanted to make one comment when thinking about legalities for early stage company. We had a company recently who relied on sophisticated counsel, but they didn't take any of the responsibility and accountability for themselves in the transaction. And so in setting up the transaction with the investors, and ultimately the company was acquired, which was great, but they didn't have a great grasp of what they had agreed to in those early investment documents, and were surprised by the outcome for them personally. And so I would just say that I think it's the responsibility of the entrepreneur, but as lawyers, there is a responsibility in making sure that the entrepreneurs, even though it isn't in their realm, and it certainly isn't probably in their wheelhouse of what they understand around the legalities, there is some. I was shocked that the entrepreneur was without knowledge of these particular terms, which would make it much more lucrative for the investors than for the entrepreneurs. So it ultimately worked out for us as investors, but it was a bit of a sad story for the entrepreneur.
So, Chris Hanssens, at this point now, you're looking to potentially acquire a firm, partner with a firm at a later stage. How important are the kind of capital structure considerations that Chris was talking about to your outlook as you're thinking about making your choices? Is that something that is very low on the list? Is that something that you're considering when you're making your choices, or how does that play out?
Yeah, I would say it's low on the list, and principally just to give everybody some background, we're a lower middle market buyout fund. So different from the stages, we're typically buying businesses or investing in businesses in partnership with entrepreneurial minded operators, typically businesses that are going to be sub 100 million in revenue. So our transactions are very different. In fact, when we're sourcing transactions, it's very interesting for me to hear the different perspectives of introductions to entrepreneurs. In our business, there's so much capital today that we are doing everything we can to get in front of those owner-operators prior to there being a process. It's a very competitive segment of the market, and we think we're at the least competitive segment of what Andrew defined as private equity. So our businesses have been established for some period of time, typically jumping over those early stages to a point where you may be a $50 million business that's providing an outsourced service. As an example, you've bootstrapped the business, you've taken all that risk on yourself, and you're looking for a partner for one of several reasons. And some of the reasons we get involved would be there's a competitor that you would like to acquire, but you don't want to finally getting your mortgage paid off, leverage to the hilt at your own risk to make that bet, so to speak, or to grow the business organically, so you'll bring in a capital partner. So for us, we're really starting with a new capital structure altogether, Andrew. It's not of terrible significance to us. For us, it's all the things that Holly and David mentioned, but at a different stage in terms of team. We're looking at the business model. We're looking at the competitive landscape, and really figuring out if our operating experience is going to allow us to take the business on a different growth trajectory than they might get there on their own.
And just to clarify for the folks in there, is there a general amount of time that we've now just covered when you actually get involved from the time? Do you ever think about how long ago was it when they walked into the door of their first angel investor pitch by the time they come to you? Is it, or does it vary so much that there's really not a single answer to that?
It does vary. Just an example that I think would certainly be relevant to everybody here. We acquired a business called West Academic from Thomson Reuters several years ago, which is the publisher of legal content that unfortunately Professor Andrew here is not using, but we'll let that go. But so we had an opportunity really by one of the ways we source transactions is to call on corporate development heads at large institutions that may have divisions that aren't core. And for Thomson Reuters, after the acquisition of Reuters, really was looking for workflow solutions, information services businesses, did not see a long-term place for a business that was providing legal content in what was a pretty definable market, right? So we were able to negotiate a pull out of that transaction, and we pulled that division out. There were 45 people involved. We grew the team to 90 today that are running the business. And what was interesting in that transaction is those operators knew that business, and to your capital structure question, those operators knew that business exceptionally well, but they had the Thomson Reuters Treasury had no understanding of capital structure. So what we did as part of that transaction is we invited them to invest in the transaction, in the pullout of that, which they were thrilled to do, and it's been a great outcome for them. So it's one of the things that we're looking for is, can we help build the bench, so to speak? Can we build the management team to change the growth trajectory of the business and build that inventory into the heart of the middle market? So where these folks are thinking public offering or sale to a larger organization, we're typically thinking of growing the business to a point where we sell it to the $1 billion or $2 billion funds.
Yeah, one thing for all the young lawyers in this room, one thing that all this talk of capital structure reminded me of is the number of Excel models that come from lawyers is a lot more than I would have expected when you exit. So, brush up on your Excel, because you got to get those numbers right. I mean, we all have our own models on our side too, but it can be embarrassing for either side if the numbers don't match up. So it's not all Word doc and legal tracking software.
Running black lines.
Oh, yeah, that's right.
With all the metadata. So I guess switching gears a little bit, one question. We haven't really talked about the Philadelphia or Delaware Valley specific nature or lack there of your work. Is there something about the geography of the place or the kinds of things that are happening here that you think are worth noting? Is it the point where are we at the point where everything is national or international, or is there still something to be said about a local community? I mean, obviously the relationship piece of it is going to be hard to scale, notwithstanding LinkedIn. But what does one say about the Philadelphia entrepreneurial space in 2017, as opposed to maybe 2010 or 2013 even?
I mean, I'll make a quick comment on that. I think if you look at, and we look at this because we are, although we will do add-ons to our platform companies anywhere in the world, we start with a platform that's closer to home. So broadly speaking, east of the Mississippi is where we look for platform investments. If you look very specifically at the greater Philadelphia region and the Mid-Atlantic more broadly, historically it's been a net importer of capital. So I think the folks here would probably echo this as well. There are a lot of great investment opportunities over time. Most of the not most, but there's been a lot more capital coming into those opportunities than local capital. And I think that's created a lot of opportunities for funds that are in this region and in this area, because to your initial comment, Andrew, relationships are such a large part of each of our businesses that establishing those relationships and that trust, it may not at the end of the day win you a deal, but it at least gives you an inside track on an opportunity.
Yeah, I would say it really starts with the stage of the company. I think to really understand the answer to Andrew's question, you have to kind of look at the full spectrum. From very early stage companies, most of the money that they are going to raise, is very first step out of the gate is going to be either from friends or family or from angel investors. Angel investors are high net worth individuals that have an interest either in a particular industry or just investing in local companies to support the ecosystem. And usually, obviously friends and family can be anywhere, but in terms of raising money from angels, that's generally going to be done in your local community. And the Philadelphia community probably doesn't have the strongest angel network, but it also doesn't have the weakest. And there are plenty of opportunities here, angel groups, angel funds that can be accessed. We also have a local organization called Ben Franklin Technology Partners, which is an economic development agency funded by the state. And they are a great source of capital for early stage companies. They will usually invest in a very early stage company, usually requiring the company to match the amount of funds that they're going to put in. So the company has to go out and raise from either the friends and family side or angel investors an equivalent amount. But if they're able to do that, then Ben Franklin will step up. The process is rigorous. The company needs to like I said earlier, have its act together in a very big way in order to get through that process. But it also is great because it then gets the company very organized and much better equipped to talk to investors like Holly and David, because they're not going to do put them through the same kind of rigor that Ben Franklin does up front. I mean, that really is difficult for an early stage company to have that much together, but it's a well worth going through the process. When it gets beyond that, then I think it becomes much more national. Good companies in this region can raise money from funds outside this region. But I think, the investors, I think both at Holly's stage and David's stage, I don't know whether you guys have geographic limitations on what you do, Some funds do and some funds don't. A lot of times it's a practical question of how many planes investors want to get on and how far they want to travel to go to board meetings. And sometimes it's a requirement within their fund documents, the arrangements they've made with their investors, that they're only going to invest in a certain place. Sorry. It's 5 o'clock somewhere. Actually, almost here. We'll be done by cocktail hour. So from our perspective, it really depends on the type of business. There are certain businesses that are going to attract venture capital from outside the region more easily than other businesses. And sometimes based on the relationships, it's better to stay local and to look for the funds here. We have local funds. After that seed stage, we have several kind of early stage funds, Holly's among them, and then we have several kind of what we would call growth stage funds, David's group among them. And then we don't have a lot of bigger kind of minority investor firms, but we certainly have, as Chris pointed out, firms that do what he does in terms of the buyout world, which frankly, that becomes a lot less local. I know Chris has some local investments, but they're not all local. So it's really from the early stages through the later stage, it really depends on the type of investor you're looking for and geography you're going to get that money from.
So Philadelphia in 2017 versus even 5 years ago, I think that just there has been a groundswell. Well, two major points. One is that I think that entrepreneurs now have congregated more in the city than out, in the western suburbs. Now, that being said, there are still some great companies out here, but more and more, the energy is primarily in Center City. Number two is that, I think that it's very, very obvious to me that I'm seeing a lot more early stage startups, right, than even 5 years ago, right? And a lot of those people are fresh grads from, graduate programs, undergrad programs, and I'm seeing this, not just anecdotally, but actually I was just on a call with Ben Franklin Technology Partners, and actually about a little less than a year ago, Safeguard partnered with Independence Blue Cross and Ben Franklin to fund digital health related startups. And combined, we committed $6 million to invest over 5 years. And literally we are, I'll just say this, we're way ahead of pace. And it's not because, as Chris mentioned, the Ben Franklin process is a very, very strenuous process, and it's a good quality process. They have not changed that one bit, and so it's every bit as hard to get to partner with Ben Franklin for capital as it used to be. But the number of companies, especially in digital health, actually, has just greatly increased. So I think the energy is great.
Yeah, I would only add, if you just look at the city of Philadelphia and the improvements of livability in the city over the years, particularly within the last 10, even the last 5 years, I think the type of talent that an entrepreneurial venture needs to succeed is now more willing to stay in Philadelphia, live in Philadelphia, and so as a result of that, these companies really are going to able to have the talent that they need to grow. So long term, I think that's why you're seeing more visionary entrepreneurs who would just rather stay in Philadelphia than go to Silicon Valley or New York, because they'd rather live in Philly, and they now have the right teams in place that they can genuinely attract to their venture.
Yeah, and 2010 is an interesting year. Actually, a lot of people here don't know, I don't think, that Venmo started in Philadelphia on 20th and Locust. And I think in 2017, if this company had started in 2017, they'd still be here. But instead, they moved up to New York. I think they spent a summer here, maybe 6 months here right after graduation, and went up to New York right afterwards. I think in 2017, they're still here.
Yeah, I would echo what they all said, but there's no shortage of deal flow at the early stage. there continues to be constraints around capital at the early stage. There are some unique things happening. What you all do is phenomenal. Ben Franklin is doing more smaller, earlier stage investments. Some of the other farther along firms are creating smaller pots of money to try to put some get some more chips on the table at an early stage. First Round Capital has a dorm room fund that helps invest in some of these early stage companies. But as we have things go through the process and have great exits and get more, I think, press around how great we are at an early stage, more capital will come in at an early stage. There aren't enough of our firms around, and unfortunately, we're not investing in everyone. But the great news is, I could see companies all day long, and so there would be more and more coming, and we're seeing less wanting to leave. So I think it's one of the things that we'll hopefully figure out in the near future is how do we keep more of them here and either get more of our own funding sources locally or just continue to bring more capital in at an early stage.
Well, I'll just ask one last question, and we'll open up to the audience, who I'm sure have lots of questions. But what I've just heard now is that there's actually a fair amount of leverage or market power that maybe some of these folks have. Maybe that's not the right way to put it, but one could imagine that as they're negotiating for an investment from one of your funds, that depending upon the quality of where they are, the quality of whatever their earnings are, whatever their prospects are, you might have different sorts of negotiations, not just over price terms, but over governance terms, over metrics that you're going to be looking for. How idiosyncratic do these deals look that these entrepreneurs are striking with you, aside from various sorts of the actual price on the equity that you're taking or the
forms, right?
Sorry?
I would say, I think a lot of it is a function of leverage, although it's within certain ranges of possibilities, particularly on the early stage and growth stage of VC. You have kind of a concrete set of things that get negotiated in any particular deal, but where you fall on the spectrum of some of those things, you may have leverage to get some more founder company friendly provisions if you have a hot deal and a lot of options and a lot of term sheets on the table. If there's only one game in town, the VC who put out that term sheet has a pretty good idea of who else may be in the mix. And so, but there's not a ton that gets negotiated. And as a VC, you have certain parameters of what you're going to invest on. And just because someone is just an unbelievable entrepreneur, you still have fiduciary duties to your stakeholders. So there are terms and governance provisions that you need. So that's why I would say it's within a framework of things that get negotiated, but it always helps as a founder to have leverage of different options. And you don't necessarily go with the best terms, right? You really, the terms are secondary, in my opinion. You want to have the right partner, and if you're fortunate enough to have a lot of different offers, I personally wouldn't take the best valuation. I would go with whoever the best fit is, because things may not always go well. There may be someone who, even though the valuation is less, they're just much more of a better fit for your business and a long-term ability to get you the right people and introductions that are going to help your business succeed, and they just have a better reputation. So it's not always about price and best terms.
I would just say something that's a little bit tricky in Philadelphia in early stage, very early stage, is that it's very collaborative, which is either very good or very bad. So the early stage firms, say there's a dozen, there's probably less than a dozen, but we all know each other very well. We all look at many of the same deals, and because we might be doing a $500,000 investment in an investment that's $3 or $4 million, we're naturally collaborating, and we want to collaborate because we want to get our entrepreneur off the fundraising trail and back to work. So it's something that is a bit naive sometimes for the entrepreneur who thinks that they're negotiating between firms or against firms or over-negotiating. And I've seen a couple instances where we really liked the investment, we really liked the entrepreneur, we just wanted to get it done, and they are trying to do a little bit behind-the-scenes negotiating, and the deals fall apart very easily. Because the other thing is early-stage investing it's a bit emotional, it's not very scientific. we see new deals all the time and new companies all the time. And so, unfortunately, I think this trickiness around the collaboration is something that often entrepreneurs don't truly know until sometimes it's too late.
And Holly raises a good point. Time kills all deals. So when you have a deal with someone, you want to get it done quick, because the second they see something that they like better, you've got a problem.
Yeah, and just like so, at the heart of it, right? Investors are selling capital, and so when you're selling anything, it's a market-driven process, right? And so, just like anything, there is a market that kind of fluctuates over time, and it kind of fluctuates with geography. So, a West Coast deal, you probably won't see any sort of a participation feature if it's a software deal, right? Most East Coast firms right now are still getting participation features, but there's a cap on your participation, right? Now, it wasn't like that maybe 3 or 4 years ago. Participation is coming back a little bit. And I think, not to give the lawyers here too much of an ad here, but to know this stuff, as an entrepreneur, you can't be expected to run your business and know exactly what market is for terms, right? That's what good lawyers do for you. So I think it's really important to have good advisors on your side.
All right, well, with that, I'll open up the floor to any questions out there.
So first of all, Holly, as you know, and Chris, as you know, start over again. So, as you know, as an attorney, the first fee that a small business is going to encounter is the legal fees to create the entity, and that can be sizable. And the second thing, as you know, Holly, is there's no such thing as a bad projection when you're looking at a small company. And so to that end, and you mentioned your deal levels are somewhere between 500,000 to about 3 million. So,
In terms of the deals that we
so how many deals would you look at before you do a deal?
We could look at 100 to do a deal.
Yeah, and over a period of a year? What time period would you say that is?
No, I say we do a couple deals a year. We're probably looking at 200 or 300 deals in that year.
No. That's significant. And then you're a public company, Safeguard, right?
Yes.
So when you're doing a deal there, I think your investment range is significant. What's the deal range that you get to see that you typically would invest in?
So the fact that we're a public entity doesn't, we have our investment strategy, right? And I'll just speak to that part. So our investment strategy is the core of what we do is we invest anywhere from $5 to $15 million in a Series A or a Series B company. So a company is typically generating revenue, has raised institutional capital already, and is in one of the 3 categories that I mentioned before, right? FinTech, digital media, and healthcare IT. Now, in addition to that core business, we also do some seed investing. We're a little more opportunistic with that. Like, we don't have a kind of the machine running to generate and source new deals on that side. We're primarily like I said, opportunistic on that side. And as part of that seed financing, we do these Ben Franklin deals, right? So those are, typically the full round is anywhere from about 100,000 to 500,000, of which we'll participate 1/3. So we'll do like $100,000 or so on average per deal with Ben Franklin. And then and I think we've done now, I believe, 4 seed deals, and the average seed investment has been, call it like 500 to $1 million or so.
Is there, what type of multiple do you typically look at as an exit strategy?
Yeah, no, that's a really good question, right? So it definitely depends on the stage. So I'll only speak to the core of our business, because that's really what moves the needle for us and our investors. So in that core business, $5 to $15 million investments, we're typically looking for anywhere from 3 to 5 times our money over 3 to 5 years.
And Chris, how about you? When you're buying a company and you want an exit strategy, what type of multiples are you looking at?
So on the exit, on cash returns, so we're typically underwriting our investors tend to be the institutional pension funds, insurance companies. Just to give you a little bit more detail than you're asking for, they are typically underwriting the private equity class as their highest yielding allocation in their broader portfolio. And so that tends to range. One of our investors, a state pension fund, was using the S&P 500 plus 400 basis points. They've since dropped the premium and are now using a small market public index as the benchmark. So in private equity in general, most institutional investors are trying to realize low to mid-teens net returns, and net means all the expenses that if you open the paper any day, you'll find an article about the expenses of private equity investing. So we're as a small buyout fund at an end of the market, we're trying to drive returns that are higher than what the broader private equity market is looking for. So on a gross return basis, typically 25 to 30% gross returns, which should allow us to net upper teens to low 20s to our investors. And so depending on how long our hold period is, the lion's share of our transactions we want to yield in the, call it 2.5 to 4 times. We'll find in this market where our exit multiples are at historic highs that we're able to do better than that in an exit scenario. The negative flip side of that is our buy side opportunities are much more expensive in this market, which obviously would bring down your expected returns on new deals, but not too dissimilar really from where the other classes are underwriting. The difference is, I think, the dispersion of returns in our deals is going to be much, or should be much tighter than the dispersion of deals in an early investor's portfolio.
Thank you. Holly, what kind of return are you looking at, and/or what type of a percentage of the company do you look at when you're trying to do, say, a $2 million deal?
We're earlier stage, so it's risky. So we're looking for, you're really looking for 10 times your money back, because you assume in a portfolio of 10 companies, one's actually going to achieve that, but that's what you're hoping for in every investment.
And a board seat and all that other.
It depends.
Yeah. Thank you.
Other questions?
So this is primarily for David, but perhaps for others as well. So I'm curious, investing at the stage that you're investing at, are you seeing companies that are coming up through the Philadelphia entrepreneurial ecosystem? So say they've gotten rounds of investment from, say, Robinhood, Angel Group, or similar established groups in the region, or are you primarily seeing companies that are coming to you at this stage, but coming from a broader range of geography?
So, we do have to look, across, primarily we're I-95 corridor focused, right? So within a day trip, a board meeting that you can do within one day and not have to fly out to California. That being said, we do have a handful of Bay Area companies. We've got a handful of Madison, Wisconsin companies. But to answer your question about Philadelphia, actually, I think we do have actually several, I don't know, like a half dozen at least Philadelphia-based companies, and it seems like most of them have, at least the younger ones, right, the more recent investments have come through that, the kind of the more well-known Philadelphia angel investment community, right? So for example, CloudMine is one, which literally seems to have gotten angel investments from like every angel group in Philadelphia. So yeah, it's been great.
We have time for maybe one more question.
Holly mentioned before the entrepreneur who was surprised by the exit, and the
conflict, if you will, between the entrepreneur and the investors. I'm under the impression that there also can be conflicts or a lack of community of interest between early stage investors and later investors, as well as the founders. And so I was wondering from the panel, what are the terms, particular terms, if there are, of the documents that people enter into that the principals and their legal advisors should be most interested in to avoid those types of conflicts?
Sure. It gets a little bit to my point about governance, right? So certainly how the composition of the board of directors works is a critical component of how those sorts of governance decisions get made. So I would focus there. I'd put a lot of attention on that provision. I'd put a lot of attention on the founders' vesting terms and how they read. What I mean by that is how long does the founder need to stay at the company? What happens if he is terminated either with or without cause or resigns for good reason? There's a convention of terms that are fairly typically agreed to, but they're also relevant. And then I would also focus on a provision that's called a drag-along provision that's in a stockholder voting agreement, and that's the provision where a certain group of constituencies, it could be the board plus this plus that, how that governs the exit, and that tends to get negotiated in connection with the transaction. But the reality is, regardless of what the documents say, investors also have leverage in terms of the terms that they have in their economics. And if you can't properly satisfy the economics of a particular class of investors, you may have a negotiation with those investors on the hand. Similarly, if management's common stock is out of the money in terms of a deal because of dilution and liquidation waterfall issues over time, but yet the acquirer really needs that management to continue to have a successful exit and acquisition, then management's going to have a lot of leverage to negotiate things. So some things can change in time as the cap table evolves, but you really need to understand what the key economic terms are of each class and make sure that as you bring on new constituencies of investors, you're having those sorts of conversations as to timeframes for exit, because if one set of investors wants to exit after 3 years and got in at one valuation, and another investor at a future inflection point got in at a much higher valuation and wants to see the upside really grow before they sell, and management would like to sell because it's their first deal and they want a nice win and to work with this particular acquirer, there can be some real tensions there that emerge that you have to navigate. So the more you can communicate about those sorts of items before you're really in the heat of battle of an actual exit to consider, the better off I think you'll be.
All right. Well, with that advertisement for my corporate finance course, we'll stop. And we'll take a moment to clear out, and I want to thank the panel, though, before we do, for all your thoughts. Thank you very much. Thank you.